Welcome to Wealth and Means. Advice dressed up like hard work.
Each week, we explore ideas that help you pause, reflect, and think more deeply about the opportunities all around you.
It's the perfect mix. A little information, a few stats, some real-world insights, and just enough deep talk to make you feel smarter before your second cup of coffee.
Today's episode is loaded. We've got what you didn't see in the news, your 5-minute jumpstart and wake up ready, a knowledge bomb about stock ownership, some funny jokes in Humor Me, a timely topic for Thanksgiving dinner in the greater debate, and we'll wrap it all up with another Invent Again story.
A quick thank you to our sponsor, Nost Moments at nostmoments.io. Share your most precious memories. Share the Nost Moments. All right, while everyone was arguing about gas prices and Taylor Swift's jet tracker, the real internet economy was quietly doing jumping jacks in the background. Let's start with the green powder that could take down coffee's crown, matcha. Searches for matcha drinks are up 500% over lattes. Yeah, 500%. Blame TikTok, blame the clean caffeine crowd, or just blame the fact that everything lime green photographs better than brown sludge. Matcha's gone from yoga mom accessory to Gen Z staple, and here's the kicker. It hasn't even hit its holiday wave yet. Expect December to look like a pastel green Starbucks fever dream when the gift boxes drop.
Matcha season meets Christmas season. What a time to be an algorithm.
Exactly. And speaking of holiday nostalgia, Thanksgiving Grandma is back for her 10th viral lap. You remember, the woman who accidentally texted a stranger and ended up inviting him to Thanksgiving dinner, and they actually kept doing it? That story's now a decade old, and it's somehow pulling 300% more shares this year. Netflix has a movie in the works. Gen Z is treating it like a seasonal tradition, and we've officially entered the era where wholesome internet lore has a release schedule. Now, over on the darker side of the feed, World War III memes are exploding. No pun intended. After the election, search traffic jumped 150% as people started joking about draft letters and bunkers. It's twisted, sure, but it's also sociology in real time. This is how a generation processes constant geopolitical chaos. They turn existential dread into punchlines. The line between coping mechanism and cultural commentary is officially blurred.
If laughter's the best medicine, Gen Z is dosing heavy.
On Wall Street, meanwhile, a few tickers started whispering louder than the megacaps. Oscar Health, ticker OSCR, popped 22% as it finally figured out how to make money in digital insurance. For years, it was the kid promising to disrupt healthcare with an app. Now it's the adult paying its own bills. Prologis, ticker PLD, the company that basically owns the warehouses behind your Amazon Prime addiction, jumped 18% because e-commerce logistics are the new beachfront property. And for those betting against tech's endless party, ticker SQQQ, the inverse NASDAQ ETF, saw a one-day volume spike of 130%. Translation: the crowd that once worshipped NVIDIA is now buying insurance against its own optimism.
Nothing says holiday spirit like a short position on Silicon Valley.
Exactly. And if you want to see where the next hype cycle's warming up, look at BTQ Technologies, a small-cap quantum computing firm up 28% because AI fatigue is real, and investors are already auditioning the sequel. Then there's VitalHub, a healthcare software player quietly up 20% just by expanding overseas. Proof that sometimes the real money hides in the least sexy corners of the market. Now zoom out a little. Trend trackers show a surge in AI-powered everything: text-to-audio tools, digital boyfriends, algorithmic journaling apps. Add in finance curiosities like embedded lending and GLP-1 supplements, and you can feel the next wave forming. It's not just content anymore. It's the commerce of self-optimization, AI that talks to you, sells to you, and maybe even flirts with you.
Somewhere out there, a chatbot just whispered, "I love your spending habits."
And while that's happening, trading screens are flickering with smaller names. Exact Sciences, National Beverage, even uranium plays like GovEx, showing institutional fingerprints before the retail crowd catches on. The big story isn't that the market's moving, it's that it's rotating. from mega caps to mid caps, from hype to quietly competent companies ready for their main character moment. So if you blinked this week, you probably missed it. Matcha went mainstream, grandma became a franchise, memes became diplomacy, and mid caps started writing their comeback story.
And that, my friends, is what you didn't see in the news. But now you can say you did. Now let's wake up ready.
It's Thanksgiving week in the US, which means lighter trading, heavier pies, and just enough data drops to keep economists from falling asleep on the couch. Let's walk through it day by day. We start slow, as Mondays like to do. The key spotlight is Germany's IFO Business Climate Index. Think of it as the Eurozone's mood ring for manufacturing. The consensus is around 88, which isn't bad, but not exactly Oktoberfest levels of optimism. If that number ticks higher, investors may start whispering, maybe Europe's back? Over in North America, Canada releases manufacturing sales while the US checks retail sales and producer prices. If the PPI comes in hot, anything over 0.5%, markets might start betting that the Fed's rate cut party gets pushed to 2026.
So basically, Monday's about figuring out if prices are done misbehaving.
Exactly. And Christine Lagarde speaks at 9:45 a.m., which in central bank speak means caffeine is advised. Tuesdays, when things start to get real. The ADP jobs report hits at 8:15, a sneak preview of how tight the labor market still is. If that number looks strong, brace for another soft landing victory lap from the Fed. Then we get the Case-Shiller and FHFA home price indexes, which are the pulse of the housing market. If both show prices still rising despite higher mortgage rates, that's a big question mark for inflation hawks. Are shelter costs the ghost that won't die? And keep an eye on consumer confidence at 10 o'clock, with consensus around 94. If households start feeling down, that ripples straight into retail and tech earnings next quarter.
Speaking of retail, isn't Best Buy reporting?
You got it, pre-market. Everyone's watching how early holiday shoppers are spending on gadgets. After the bell, Dell steps up with earnings that could reveal whether corporate hardware demand is rebounding or just running on fumes. And oil traders, your moment comes at 3:30 with the EIA crude stocks report. If inventories fall, expect headlines about tight supply and maybe another 2% pop in WTI. Wednesday is the pre-Thanksgiving buffet of data. We start with durable goods orders, up just 0.2% if forecasts hold, signaling businesses are still cautious on big-ticket spending. Then comes the big one, third quarter GDP, second estimate. If growth gets revised upward, that's Wall Street's cue to say, told you the slowdown was overblown.
And what about inflation?
Right alongside GDP, we get the core PCE price index, the Fed's favorite inflation metric. A sticky reading here could kill hopes of a spring rate cut faster than you can say pumpkin pie. We'll also see jobless claims, personal income and consumption, and the Fed Beige Book, which basically tells us what every region in the U.S. is complaining about economically. And for the globally minded, the large-scale solar summit kicks off in Warsaw, tying clean energy and capital markets together in ways that could shape 2026 project pipelines. Thursday, Thanksgiving. Markets are closed, and economists finally get to argue about something other than monetary policy. Globally, it's quiet, though Japan's Tokyo CPI sneaks out overnight, hinting at whether the Bank of Japan might finally exit negative rates for good. Meanwhile, Canada Climate Week Exchange continues, a whole series on critical minerals and green energy. Expect some ESG talking points sprinkled with maple syrup. Friday's not just turkey leftovers, it's retail's Super Bowl. Expect to see footage of people storming into Targets at 4 in the morning. The real economic read comes from Black Friday spending data and early consumer tech sales, the first hint of how fourth quarter earnings might shape up. On the macro side, Germany's inflation and retail sales give the ECB fresh headaches, while the U.S. wraps up with final third quarter GDP and a 10-year Treasury auction. If yields jump, it could spook mortgage markets, right as homebuyers were starting to peek back out of hiding.
So in short, the week starts with inflation worries, dips into consumer confidence, and ends with a nationwide spending binge.
Exactly. It's the economic equivalent of a Thanksgiving dinner. starts measured, gets wild in the middle, and ends with everyone napping to CNBC. And just when you think it's over, Sunday night brings China's PMI data, the global economy's compass. If it dips below 50, expect new whispers about stimulus. If it holds above, we might just get a year-end rally across commodities and tech. So that's your week. Stay caffeinated, stay curious, and as always, wake up ready.
Let's talk about ownership, the real kind. Not the I bought a stock on my phone kind, but the kind that built capitalism, limited liability, and your future portfolio. It's knowledge bomb time. So here's the deal. When you click buy on an investing app, you're not buying a vibe, you're buying a bundle of rights. That's what ownership really means. You get three things: a right to profits, a right to control, and a claim on the assets if the business goes belly up. In the earliest version of business ownership, the sole proprietorship, you were the business. Drive an Uber, sell freelance designs, boom, you're it. And if something goes wrong, the business's debt is your debt. Your laptop, your car, your house, all fair game. That's called unlimited liability, and it's the reason humanity invented every other kind of business structure. Enter the genius move, separation. Somebody in history said, what if we put the business in a legal box? That box became the modern corporation, or LLC, a person in the eyes of the law. It can own stuff, sign contracts, get sued, and most importantly, shield you from losing everything. That's limited liability. It's the invisible armor that made capitalism scalable. Then came the Dutch East India Company, the OG IPO. They chopped that legal box into thousands of little pieces called shares and sold them to the public to fund ships to Asia. For the first time, anyone could own a piece of a massive enterprise without running it. That's when the magic of liquidity showed up. You could sell your slice to someone else without asking permission. Congratulations, the modern stock exchange was born. Fast forward a few centuries. Today, every time you open Robinhood or Fidelity, you're walking into the digital version of that 1600s Amsterdam street. When you buy Apple stock, you're not buying it from Apple. You're buying it from some other investor. The app is just the broker in the middle of that 400-year-old conversation. Now let's decode a bit of math. A stock is the whole pizza. A share is a slice. The price per share means nothing until you know how many slices exist. That's why we use market cap, price times total shares. Ford's $12 stock and Apple's $109 stock are apples and oranges until you realize Apple's whole pizza is $2.9 trillion, while Ford's is about $48 billion. Want a truer sense of cost? Add debt and subtract cash. That's enterprise value, the total buyout price if you wanted to own the whole thing outright. So when you buy a share, you're stepping into a centuries-old lineage of people who traded risk for a shot at prosperity. You're buying a fraction of the legal box with a claim, however tiny, on its future profits and decision-making power. And thanks to limited liability, the worst you can lose is what you paid for your slice. That's not gambling. That's ownership, real ownership, the kind that built nations, financed revolutions, and turned side hustles into empires. The next time someone tells you investing is like betting, remind them, casinos take your money. Companies give you equity.
And now it's time for Humor Me, the lighter side of life. Here's a classic and 100% true-ish, humorous stock ownership story that still makes finance people chuckle in pain. Back in the late 1990s, a guy named Joe Campbell, a 59-year-old substitute teacher from Indiana, got a single stock certificate in the mail as a gift from his sister. It was one share of a tiny, obscure oil company that had been spun out of a bankruptcy years earlier. Joe, being a frugal Midwesterner, didn't want to pay the $35 brokerage fee to deposit the physical certificate, so he just tossed it into a shoebox in his closet and forgot about it. Fast forward to 2007. Joe is cleaning out the closet and finds the dusty certificate. Out of curiosity, he looks up the company ticker, which had changed about 6 times due to mergers, reverse splits, name changes, etc. Turns out that one lonely share, after surviving roughly 47 corporate actions, had morphed into 48,000 shares of a certain large oil company worth about $3.2 million. Joe reportedly stared at the screen, turned to his wife, and said the most Midwestern sentence in stock market history. Well, I guess I own the company now. He cashed out and retired to a life of quietly telling everyone, I beat Wall Street with a shoebox.
Speaking of Campbell's wealth, did you hear this one? I started investing in stocks, beef, chicken, and vegetable. Why? Because, as they say, one day I hope to be a billionaire. Being that rich would be broth-taking. Hopefully the market doesn't simmer down too much, or you'll find all your investments have reduced. As every investor knows, it's important to keep your money liquid. That said, let's share a moment together in the greater debate, the debate that should happen, but never does, usually because someone storms off before dessert. So we make it happen anyway. Powered by imagination, caffeine, and the stubborn belief that two adults can spar over economic ideology without turning the studio into a WWE event. Tonight's topic is simple enough to fit on a bumper sticker, but explosive enough to detonate a family group chat for a decade. Capitalism versus socialism in America. Representing the broaden ownership, strengthen labor, and stop pretending the bottom 90% don't exist camp. Zoran Mamdami. And in the other corner, representing keep the market engine running, fix the dumb parts, and don't break what funds your pension, delivered with the calm danger of a man who has outlived multiple asset bubbles, Warren Buffett. Let's begin. Zoran approaches the podium with the steady energy of a man carrying a moral algebra problem he's about to project onto a national screen. His smile is polite, but behind it you can sense a PowerPoint slide titled, America has the money, it's just in the wrong pockets. He starts softly. We are the richest country in the world, he says, yet most Americans feel like economic tourists in their own nation. Then he flicks the first domino. 3 billionaires hold more wealth than 160 million Americans. The top 10% owns over 90% of stocks. The bottom half barely 1%. The room tightens, no applause, just that heavy inhale people make when they realize the numbers aren't partisan, they're physics. Zoran moves from diagnosis to philosophy. Socialism, he says, is not about taking your house or your truck or your grandmother's jewelry. Pauses. It's about productive property, factories, minerals, patents, the systems everyone contributes to but almost no one owns. He reframes taxes as an investment. Every April you buy tiny shares of USA Inc., yet somehow you never get dividends. Why? Who wrote that rule? And this is where he lights the fuse. If we can bail out banks when they're reckless, why can't we pay citizen dividends when the country prospers? He cites Alaska's oil dividend as the plot twist no one expects. A conservative state that said this oil belongs to everyone and started mailing checks. That, he says, is democratic socialism, not theory practice. He closes with a 2-sentence thesis that lands like a closing argument. We already socialize losses. Let's socialize the gains. Let's give workers, communities, and pensioners a genuine ownership stake in the prosperity they create. The room shifts. You can feel people running cost-benefit analyses in their heads, quietly, nervously, honestly. Buffett walks to the lectern with the unhurried confidence of a man who has watched 19 economic cycles, 3 currency crises, and at least 5 eras of the Washington Consensus rise and fall. He doesn't smirk. He doesn't signal superiority. He just begins with a story he has told before because it always lands. When I was a kid, he says, John D. Rockefeller was the richest man alive, but Rockefeller never had antibiotics. No air conditioning, no smartphone, no Honda Civic that starts every morning. We, he says to the audience, live better than Rockefeller. He lets that sit. That's capitalism. It doesn't distribute rewards fairly, but it raises the floor of human comfort. Then Warren does something only Warren can do. He expands the definition of owner. You aren't outside the stock market, he says. You're in it. Teachers, firefighters, union workers, your pension funds own huge slices of American companies. CalPERS alone owns over $2 billion of Berkshire stock. If I do my job well, he says, A retired bus driver in Fresno gets a stronger pension. If the market grows, millions of working Americans grow with it. He defends stock buybacks, not with ideology, but with middle school arithmetic. When we buy back shares at a good price, he says, every remaining share becomes more valuable. It benefits every owner, from billionaires to union retirees. Then he pivots. He acknowledges inequality. He acknowledges the loopholes. He acknowledges that he should not pay a lower tax rate than his secretary. I believe in progressive taxes. I believe in closing loopholes. I believe in safety nets. But then his tone drops a half step, measured, almost paternal. What I don't believe in, he says, is killing the engine that funds all those safety nets. And now comes the cinematic montage. Buffett gives us a two-country masterclass in incentive design. Poland after communism, private property restored. Markets opened. Foreign investment surged. Tripled. Unemployment plummeted. Living standards soared. You want to see capitalism in action, he asks. Look at Poland. They embraced markets and their incomes multiplied. Then he flips the slide. Venezuela after nationalization. Oil companies seized. Farms seized. Price controls imposed. Experienced engineers fired. Hyperinflation skyrocketed. GDP collapsed by 80%. Empty shelves. Mass poverty. This is what happens, he says quietly, when a government substitutes ideology for economics. No shouting, no theatrics, just two case studies that land like the A/B testing of history. Zoran returns with surgeon steady hands. Poland is not my model, he says. Venezuela is not my model. The Nordics are closer, and they aren't starving or collapsing. They're thriving. He points to Sweden, Norway, Denmark. High taxes, strong unions, worker representatives on boards, robust safety nets, and vibrant market economies. He nods at Buffett's pension argument, then twists it gently. Yes, pensions benefit from markets, but having $4,000 in a 401k doesn't make you a capitalist. It makes you vulnerable. He highlights the American middle class's real golden age. Strong unions, high top tax rates, massive public investment, stable housing costs. That era wasn't laissez-faire. It was structured capitalism with guardrails and worker power. He calls for worker seats on boards, employee ownership funds, public stakes in key industries, universal dividends from shared resources. And then the uppercut. When the crisis hits, the wealthy get rescued first. When the boom comes, they get rewarded first. That's not a market, that's a monarchy. Warren returns with a steady counter. Yes, inequality is real, he says. Yes, wages lag productivity. Yes, housing costs exploded. He concedes the pain without conceding the solution. If you mandate that every corporation give 20% of its shares to employees overnight, he warns, you may see less investment, fewer startups, fewer jobs. Capital doesn't disappear, it moves. He prefers stronger earned income tax credits, higher minimum wage, public health care options, tax fairness, anti-loophole legislation, infrastructure investment, education investment. He brings pensions back in as the anchor. When markets grow, the retirement security of millions of workers grows. When markets shrink, those same workers face shortfalls. The stakes aren't abstract. And he finishes with the cautionary line that closes the philosophical distance. You can distribute wealth fairly, but first you must create it. The moderator tosses the big question. If taxes are ownership stakes, what does that make citizens? Buffett shrugs with gentle clarity. Owners, he says. You vote for management, you finance the enterprise, you deserve an annual report. He supports a sovereign wealth fund, more Alaska-style dividends, more transparency, better fiscal accountability. But a country is not a corporation, he warns. You can't shut down Ohio because its quarterly earnings are low. Zoran jumps in. If citizens are owners, campaign finance is corporate governance. Lobbyists shouldn't hold more shares than voters. We need participatory budgeting. We need transparency. And yes, we need dividends. For once, they nod at almost the same time. Zoran loads the closing salvo. We don't have a wealth problem. We have an ownership problem. Let's fix who shares in the upside. Buffett delivers his. We need innovation worth betting your life on, and a system fair enough that the winners pay their dues. That's the greater debate. Not the Twitter version, not the cable news version, the grown-up version. What did we learn? That union pensions already make millions of workers quiet capitalists. That Poland shows what happens when you unleash markets, and Venezuela shows what happens when you strangle them. That citizen ownership shouldn't be a metaphor, it should be a mechanism. And that America doesn't have to choose between capitalism's engine and socialism's conscience. We can keep the engine, we can strengthen the conscience. We can build something worthy of the people funding the whole experiment.
All right, settle in because today we're talking about one of the most underrated OGs in hardware, literal hardware, who built an empire that quietly touches every one of our lives multiple times a day. It's another story from Let's Invent Again. His name is Linus Yale Jr., and if you've ever slid a flat key into a door and heard that satisfying click, you owe this 19th century mad lad a drink. Picture this. It's the 1850s. Banks are getting absolutely cooked by safecrackers. These old-school locks? Child's play. Enter Linus Yale Jr., former portrait painter, zero formal engineering degree, total vibe shift into lock nerd. He looks at the bank vault problem and says, "Hold my brush." In 1855, he drops the Yale infallible bank lock, basically the 1850s version of L plus ratio plus you can't pick this. Then he gets cocky and invents the first modern combination lock, straight up eliminating keys for vaults, because why not flex twice? But the real money printer? He takes an ancient Egyptian pin tumbler idea. Yes, the pharaohs were already on this in 4000 BC, wild, and shrinks it down, redesigns it, and pairs it with a tiny flat key with those jagged little edges we all know. Patent 31,278 in 1861. Boom. The modern cylinder lock is born. Smaller, cheaper to make, way harder to pick. He basically invents the default door lock for the entire industrialized world. 1868 rolls around. He teams up with a manufacturing wizard named Henry Town. They found the Yale Lock Manufacturing Company in Stamford, Connecticut, and the rest is industrial age victory laps. By the early 1900s, the company is pushing 12,000 employees globally. Fast forward to today. Assa Abloy, which absorbed Yale long ago, is a $15 billion giant. And that same 163-year-old pin tumbler design is still in billions of doors, desks, padlocks, lockers, and vending machines. You can buy a smart lock for $400 that connects to your phone and your camera and your entire digital existence. But 99% of the time, the mechanical core inside is still doing the ancient Linus Yale dance.
Because some ideas really don't need Wi-Fi.
Right? And here's the kicker. This is what true defensibility looks like. One breakthrough mechanism, patented at exactly the right moment, creating a moat so wide that even in 2025, when everyone swears everything must be app-enabled, nobody has meaningfully displaced the OG Yale cylinder. Sure, some companies offer higher security variants, but for cost, reliability, and global scale, still undefeated. It's the ultimate invent once, get paid forever model. Next time you're fumbling for keys after a late night, just remember, you're interacting with tech that's older than the light bulb, the telephone, and the car, and it still hasn't been properly disrupted. In a world obsessed with digital security, the strongest link in your physical security chain is still a mechanical masterpiece from a portrait painter who died at 47 and never saw the 20th century. Linus Yale Jr., quietly one of the highest ROI inventors in history. Changed my mind. That's it for another episode of Wealth and Means. Advice dressed up like hard work.
We hope you enjoyed the range, from stocks to socialism, locks to matcha, and pensions to Poland.
Subscribe, rate, and share this episode. It helps more than you think.
We do this for you to help you have a better week, a sharper mind, and maybe even a longer attention span.
And a special thanks to our sponsor, Nost Moments, because the best investments are still your memories.
Until next time, stay curious
Stay kind.
and keep compounding.